Hi, this is Ramesh. Wanted to talk a little bit about how and where to invest in stock markets and which companies to invest in. So now here I'm very clearly talking about the investing portion and not the trading because the trading is into technicals and investing is into the fundamentals, right? So let us look at what are all the typical fundamental components actually which people have to look into when they want to invest in companies. The first and foremost, of course, will be all, to look into the sectors. Which sectors are doing well, and overall, what is the how is the global economy and how is the macroeconomic economy in the in the government in the country, and then looking at the microeconomies in terms of which sectors are doing well and based upon the fiscal policies and the monetary policies and the kind of reforms that the government has gone into, there will be various sectors which will be doing very well. Now after identifying which sectors are doing well, then we'll have to look at which companies within the sectors we can invest in. Now, the first and foremost is the market share. So there could be multiple companies which are competing in a particular sector, in a particular industry sector space. Now, looking at what is which companies hold a very good market share. So they are holding a good market. If companies are holding very good market shares, then obviously those companies are holding good market share because their product quality is good, their product the R&D is good, their technology is good, and then the teamwork is good, and that they have been able to market it well, and sales and distribution channels are pretty well, their after sales service etc as well, and all those kind of things, right? So which is why actually they have a very good market share in the business. Their business has got a good market share. So now after that we have to also look at like when we look into the the granularities, we have to look at the top line and the bottom line, the revenues and the profits, and we have to also look at how is the the top line and bottom line growing year on year and quarter on quarter, continuously. That is very important. It should be it should be a kind of a curve which should be on the rise, and it should not be something that which goes up and comes down and stuff like that. So that is another thing which we have to this thing. And then of course the next is in terms of how is the company funded, because the capital employed in the company will be two different pieces. One is the debt component and other one is the equity. So equity is people actually who have invested in the company. Like it could be the promoters plus if it is a public limited company, then there will be public who would have invested, and then there will be DIIs and FIIs and everybody who have invested in the company, right? So that will be the equity. Now the debt is something that which they will the company would have picked up from the banking industry, from the like NBFCs, from the financial institutions, and wherever whoever is willing to lend money and at a particular interest, so they would have picked it up. Now there is something called as the cost of capital. So if it is a if it is a debt which you are picking up from a bank, then typically the banks will charge an interest. So the interest will be ranging somewhere in terms from 8% to 12% or whatever. So now that is the cost of debt is what we call. Now cost of equity is basically looked at as a risk-free return plus a risk premium for the investors who have invested money in the in the company. So for them, basically, it will be something like risk-free return, in the sense if there is a government bond or something that actually which is yielding, which could yield them typically about 6% or 6.5% or whatever. Now that is a risk-free return that which they can potentially get if they were to invest in a government bond. Now instead of that, they have taken the risk to invest in this company. So which means that it has to give them much more than what the government bond would have fetched them. So that is why typically that they will want about at least about like 5% more, 5 to 6% more than this. So typically around 10 to 12% is what people will be looking at as a cost of equity when they employ it in the company. So typically when a company has acquired a lot of equity, money, and then the debt, so they will typically be running at the rate of they will have some interest ratios of something like 12% or 12.5, 13% or whatever. They have to basically kind of like their businesses will have to return them more than the cost of capital that has been employed. So basically, that will be the then we start looking into in terms of the EPS. So EPS is basically another very important component, that is the earnings per share. So the returns, whatever actually the profits, that whatever the income that is generated out from the company, now how much is the income for every share, right? That is the earnings per share is something that actually which will be a very important component to look into. How is the EPS? Now the EPS is actually the actuals of any company. Now there is, but the company will be traded in the marketplace. If it's a public limited company, then it is being traded in the market, in the secondary market at some price, at some share price, right? Now that share price actually it could be in multiples of the EPS. Now, why is that? Because actually, let's consider that some, if the EPS of a company is about 10 rupees, then it will be traded in the share price will be at about 100. So that means it's about 10x. Now, why are people paying 100 rupees for a company which is actually earning only 10 rupees per share? Is answered by the potential of the company that it has got to grow. So that is what the investors are willing to bet upon, right? So which is why that is called as the PE, the price to earnings ratio. Now the price to earnings ratio is the 10x, is the 10 that what we spoke about in this particular example, and that PE keeps on going. And if it's a huge PE, then we have to also look at what is the industry PE and then what is the company PE, and we have to compare those two. And if the company PE is within a good range of the industry PE, then it will be a better company to invest in. Now, then the market cap. So the market capitalization is another very important thing. So market capitalization is the multiplication of the share price into the number of outstanding shares. So the bigger, the larger the market cap, the larger the company, and it is a good company to invest in. Now, having talked about all these things, we should also now look into the some specifics, that is the ROE and ROCE. Now, ROE is basically written on equity, so which means that the total equity employed, how much is the returns that the company is getting from this thing. So that is the profit after tax divided by the equity component, the entire equity component. So that will be something which the investors will be looking, and the shareholders will be looking into that. But on the other hand, when you look at the entire business as such, then you have to look at the what is the total capital employed and how much is the returns of the company for that total capital employed. So that will be the earnings before interest and taxes divided by the total capital employed, that is the debt plus the equity component. So that will be the ROCE. So we have to look at how is the ROCE of a company. And the third is in terms of the debt equity ratio. So now the debt actually should not be more than the equity. So any typical kind of thumb rule is actually debt should be lesser than the equity. So debt upon equity should be lesser than 1. So that is something which is a good this thing. So when you look at an organization, when you look at a company to invest in, as I said, number one is how is the market share, number two is what is the EPS, number three is what is the PE, and is the PE lesser than the industry PE. Number four is in terms of the ROE and ROCE, and five is the debt equity ratio. So these are the initial things which we have to look into. Then after that, there is something called as the pricing power. So this is something that actually which Warren Buffett had spoken about. So he said that the pricing power of a company will be those companies actually which has got a control over the sales and profit. So which means on the top line and bottom line, they have an excellent control on, even after increasing the price of their product or the services that they do business in. Okay, so after inflation adjusted this thing, if they are able to increase the price and still able to hold on to their market share and the demand, and still keep increasing the the top line and bottom line year on year, then those are the companies actually which has got a very good pricing power of pricing, and then those are the companies in which you can go safely and invest in. Now the other thing which we have to look into is in terms of the leveraging the debt. Now people talk about whether the debt is good or bad. Now the debt is, if you have taken a debt from a bank, then as we spoke about earlier, it has to be, the debt interest has to be met, year on year, whether the company is doing, the business is doing a profit or the loss, it is immaterial. The interest has to be paid out, and if it's a long-term debt, then after 5 years or 10 years, whatever, at the end of the 10th year, the complete principal has to be repaid. So there is no two ways about it, right? So now, so the debt is something that actually which becomes an every year expense. I mean, it has to be considered that way. But at the same time, if your the cost of capital of the debt component, if it is lesser than the ROCE, which means if the business is able to generate better returns when compared to the cost of capital for debt, then that kind of a debt leveraging is a very good this thing. So you can potentially have debt, it doesn't matter, but as long as the debt equity ratio is lesser than 1, and if your ROCE, return on capital employed, is greater than the the cost of capital for debt, it is a good business to be, yeah, good this thing be in. Then the next this thing is in terms of the dividend. So we have to also look at in terms of like how good the company is in terms of the dividend payout. So how are they giving the dividend? So basically, any company which has got a which has got profit after tax, which is a positive number, then they also give a component of the profit of tax. They actually share with the they share it with the the shareholders as dividends, right? So now, if they are actually giving out a good, a kind of dividend payout year on year, so that is a good company to invest in, right? And if you look at the EPS, I mean, actually, you have to look at the EPS if it is growing at a good rate for the past 5 years, and in the same token, if the dividend payout is also growing at kind of year on year for about 5 years, and if the EPS growth rate and the dividend growth rate is matching, then that is a good company to invest in. Okay. Now the other thing is in terms of the we have to the kind of dividend payout ratio. The dividend payout ratio is basically the dividend divided by PAT. So now the dividend payout ratio, like how is that? So if it is how much portion of the profit after tax is being given out as a dividend. So it could be it could 20%, 30%, 40%, 50%, whatever it may be. So if the company is actually regularly paying out good, if the dividend payout ratio is very good, then that is a good company to invest in. So let me just kind of recap all the things what we spoke about. So number one is in terms of the the sector. I mean, which sector is a growing sector. Two is what is the market share of the company. Three is the top line and the bottom line. Four is in terms of the growth in terms of the revenues and the profits year on year, quarter on quarter. And fifth is the EPS, the earnings per share. How is the earnings per share? Sixth is in terms of the PE, the industry PE versus the company PE. Then the market cap, how, I mean, is it a good, is the considerable sized company? And six is in terms of the ROE, and seven is in terms of the return on capital employed, and then the debt equity ratio. The debt equity ratio, if it is lesser than 1, and then we also talked about leveraging debt. So the cost of capital of the debt, if it is lesser than the return on capital employed, then it is a good company. And then the dividend payout. So the company will be paying out dividend at regular intervals of time. So how is the dividend payout and dividend yield? And then the comparison of the EPS growth in 5 years versus the versus the dividend kind of payout per share growth in 5 years. If those two are matching, it's a good this thing. And finally, the dividend payout ratio. I mean, if that is also a very good thing. So these are all the like very high level kind of things to constant to look into before investing in any company, right? So I just thought I'll share this with all of you. So thank you.